Good afternoon, good morning, good evening, wherever you happen to be watching this episode of Down the Middle. Welcome. I am so pleased today to have with me Marlena Lee. She is Dimensional's Global Head of Investment Solutions. And in addition to that, she is a member of the Investment Research Committee. We'll get to what she does for a living, which you know the drill by now, Down the Middle watchers. We'll get to what she does during her day job shortly. But first, we're going to do some compare and contrast. So my mother was very frugal growing up. My mother still is very frugal. My father was a spendthrift and believed in debt. And their differing approaches to budgets, finance, investing, savings shaped my life.
Yeah.
So tell me about your mom and dad.
Well, it sounds like we might have grown up in the same household.
I know. Or yes, like sisters from the same mother.
My mom was, frugal, cheap,
yeah, frugal,
something along those lines.
I try and use the word frugal.
Frugal,
yes.
Okay. Sure. So I mean, granted, she grew up incredibly, I think we're supposed to say modest, not poor, but she saved quarters, dimes, and she was just very, very cautious with how she spent.
Yep.
Whereas my dad, I just remember he would go to Reno. We lived in San Francisco.
Yep.
Every weekend and gamble, and he, always in debt, loved to be the big spender amongst his group of friends. And yes, that causes tension, certainly, and it definitely shaped my view on money today. Because I do have two parts to myself and how I think about it, because I know that money can, people who say money doesn't matter, doesn't bring happiness, I certainly agree with that, but it can certainly cause strife.
Yes, the flip side of it is, yes, that it can cause a lot of strife, a lot of tension. I read something a few days ago that money can't buy you happiness, but it can get you the next best thing.
Oh,
and
that's
I thought
good.
that was kind of deep.
Yeah.
But you weren't sure what your pathway was going to be into this world of finance, because you were going to sit tight after you graduated.
That's right.
Tell us where you were in school.
Well, so I went to school first at the University of California at Davis. So I did my undergrad there, and then I did my PhD at Chicago. But how I did that was, I didn't know that I wanted a career in finance. Most people are surprised by this, but I was never actually a very good student, and all through college, actually. Huh. And I'm
surprised.
I had a professor, and he was just such a wonderful mentor to me. He was the first person that really, I guess, thought that I could do better than how I was doing. And I have kind of a rocky thing with my father, so
sure.
He was the first person that really made me want to try at school. And I don't know, he just took me under his wing. He asked, well, what's your plan after you graduate? And I was like, okay, well, my boyfriend doesn't graduate yet, so I'm gonna hang out.
Yep.
Find a job at Davis. It's not a great city for career prospects.
Sure, of course.
But he said, well, that's an absolute terrible idea. And he planned my next 7 years of my life. He said, well, you're going to get your master's here, and you're going to teach for me, and then you're going to go to Chicago, you're going to study under Professor Fama, and after that, he said, and then you're going to go start your own hedge fund. So, I followed it for 7 years before I said, no.
Back the truck up. Are you serious? He had all that planned out.
He did.
It's a lot of detail.
He's amazing. Well, even for that first year, he said, here are the courses and which teachers you're going to take.
Do you stay in touch?
Yeah, I just sent him a holiday card. He's been probably the most influential person in my life. It's funny how those little just connections carry you all the way through. And I've always had a lot of mentors throughout my career, but he was certainly the first one that got me on this path and really made me kind of shape up and care about something.
I try and convey to my children the importance of, I try and convey that undergrad is just a conduit. It's just what's going to allow you to go to graduate school or get your PhD one day or go to law school. It's just a conduit. And we've had education inflation in this country.
Yeah.
To where now you used to be able to have a great career if you just had an undergraduate degree a couple generations ago.
Yeah.
That bar is higher than it used to be.
It is a lot higher, and people can get lucky, but it does seem like you have to stay in school longer. You have to have a very well-rounded resume, and it's stressful being a mom these days.
Oh my gosh! I mean, and I think this generation. My children are right now 17, 15, 14, and 14. We were talking about that before we started filming. And communicating how difficult life can be. Even if you're talking about a millennial. I mean, millennials have never really gone through a true recession.
Yeah.
And so let's use that as the challenge that you've had in telling people how important not just how they invest is, but that they save.
Oh my gosh. So there's so much to unpack there. So let's just start with saving.
Yeah.
And I think that it's just so important to start early and to be smart about how you do it. So, I talked about how my mom, she was so, I'm clearly bitter because I didn't get everything I wanted growing up. I had not very cool school supplies. That was the thing.
Yeah.
And I saw her saving so diligently. And I actually got exposure to, investing fairly young because this was, the late 90s.
Oh, yes.
We all remember what happened then.
Oh, yeah.
And my mom was one of those people who started to become very interested in investing during that time. And she would wake up really early, turn on CNBC, figure out what she was going to trade that day. My mom was a day trader, put in her orders.
Mark Haynes was on the air. You grew up with Mark Haynes on the air. Oh my gosh.
So that was in the backdrop as I was growing up. But of course, we kind of know how the story ends, right?
Yeah.
The NASDAQ fell 80% from peak to trough. And so it really impacted me very early, realizing that yes, savings is so important, but then how you invest those savings as well. And it seems so hard now that young people, we're shifting into a world where they can't rely on, a company's pension. That's a generation's past. I don't have one. So we all have to be a lot more savvy,
right,
and take control over our own finances.
Yeah.
And over a lifetime, and we all know that, just people are very bad planning over multiple decades, but that's what it's going to take.
Yeah, I mean, all of our kids had mayonnaise jars that they would put quarters and nickels and dimes into, and whenever we would go once a year to the bank and deposit all their coins and whatever, we would double what they put into savings as a reward for not spending it.
Yeah.
And it worked 50% of the time.
Oh, well, that's pretty good.
I've got two who are kind of frugal like me, and I've got two who just spend every dime that hits their hands, every penny.
Hopefully, I have that saver. For this past year, my kids got, honestly, way too much cash for what's healthy for a 6 and 8 year old boy. Just all of these, red envelopes with their New Year's money, birthday money over a pandemic period. It just all came at once. And my oldest son, he handed me $1,000, and he said, "This is for my college fund."
Oh.
It just broke my heart. The younger one,
Oh, well. Yeah, my oldest Alpha he's my spender. I mean, I'm like, you're not the Dos Equis man. He golfs, he sails, he's a pilot. I'm like, is polo next? I mean, do you think you're but it's very difficult to convey to certain age groups, especially if they grow up in affluent areas, how important it is to save. And I think that's why we have 1 in 4 adults still living with their parents.
Yeah.
Because they never learned how to walk, so now they can't run. They're not financially independent.
Yeah.
And it's a scary notion.
It really is, because you have to not only start early, but it has to be a habit. You have to have a discipline out of it and just continuously save and also be very smart about what you do with that savings. So that's something else that worries me. To your point, a lot of these, it's been a long time now, more than a decade since our last really bad downturn.
Yep.
So you have a group of young investors that have only known a bull market. I think I read something this last year with just double-digit returns, or even the last 2 years, that's not typical.
That's not normal.
That is not normal, and if folks are expecting that, and I was reading something where it was a survey where, young folks who've only experienced that type of market, they expect 30% return every year. That's just not what the market has returned.
At the very beginning, one of the opening scenes in Fed Up, I talk about Alan Greenspan's obsession with the stock market. He had to have, when he got to the Eccles building, he had to have what happened in markets overnight, where stock market futures were trading. He had just this obsession. So 2 months into office, he starts August of 87, 2 months into office, October 1987, the stock market melts down. And within weeks, he's leaking information to New York bond desks about prior to Fed injections of liquidity into the market.
Oh, wow.
This was prior to there being an FOMC statement. But that's when the Fed put was born.
Oh.
And investors believe that no matter what happens to the market, that the Fed's going to be able to step in and save them. And I don't envy you, because you have to guide these investors.
Yeah. I mean, the only one thing you can do, or that we do, is to say, okay, over the very, very, very long pull, markets have returned something closer to 10%, and it's never 10% a year. You also have a lot of good times and bad times. Yeah. So how can you make sure that you form a portfolio where you're going to stick with it, even when markets return minus 20,
Discipline.
Exactly. Discipline is so important. Discipline in savings, discipline in investing.
Mm-hmm. Agreed. So speaking of which, we live in a world of very high correlations, whether we want to believe it or not. Even private equity, I was just writing, even commercial real estate. We've got cranes behind us. It becomes pro-cyclical when you have meltdowns. And talk to me a little bit about studying under Gene Fama. I mean, just go back in time and just what was that like? Because you said it was before the Booth School of, before Booth was Booth.
That's right. So I had Professor Fama as a student. Let's see, that would have been 2003. And
he's 89 years old.
Yeah.
He's still
so sharp.
Yep.
I mean, the man it's amazing how he can distill just these really complicated concepts into these amazing one-liners.
Yeah.
So it was fantastic because you know, there's really no one better to learn the foundations of finance from the father of finance himself.
Yeah.
But he instilled just this idea that he's always just after the truth. You don't get a sense that there's an ego involved at all. Mm-hmm. He can be quite pointed, but
that was a diplomatic word.
But it's always after the search for the truth. And also you can't hide in kind of squishy understanding. Mm-hmm. It's got to be, if you can really understand it well, you should be able to distill an idea down to a sentence.
Yeah.
So he really taught me everything I still retain about finance today, but also just about a method of learning. And he's very open-minded and always just looking for the truth, but at the same time incredibly skeptical. So that doesn't sound like it goes together, but somehow...
Well, you have to, I mean, the truth is not, it's not static.
Exactly.
It's dynamic.
Exactly. But so willing to change his mind, but not following any kind of fad. Yeah. There has to be a pretty good rationale behind it, lots of data, because we all look at the same data.
Sure.
And to your point, markets can be quite correlated, so you have to be very careful of, am I just seeing the same data over and over and over?
Right.
Or is it actually new information? But with lots of new information, absolutely willing to change his mind. So that's something that I've taken with me throughout my studies, throughout my career, and is something I certainly apply to my job and my life. But also, he is an amazing teacher. So now in my role of, I communicate with lots of folks, and
you've got a team of 70?
Getting close to 70, yes, that's right. But yeah, or even just speaking to our clients or investors.
Yeah.
How do you make it so that you're taking a person on that journey with you, right? Like, Fama was never really just a lecturer. It was his mode of teaching was do a ton of pre-reading and homework, and let's come in and have a discussion. And it wasn't him talking to you, it was him pulling the information out of you. That is amazing. And it is it's rare. It is rare.
I'll tell you, so people are always like, you are not material for a bureaucrat. How in the world did you ever end up working at the Federal Reserve with people who are the opposite of what you've just described? I mean, they do their dissertations and they take that one strain of thought for the rest of their career.
Yeah.
And that's it. They just kind of massage their dissertation for like 40 years and then they have a good pension. And then they're a good central banker. Actually, a bad central banker, but a qualified central banker.
Okay.
Richard Fisher had his MBA in finance. He started at Brown Brothers in New York. Working for him, having him be kind of the oddball Federal Reserve president who was not a PhD in economics, who didn't live and breathe Keynes. It was so refreshing, but he would come into FOMC pre-briefings with this huge pre-brief book. And the PhDs would all be gathered, and they would be so deflated because he would have all these little tabs here and there in different colors, and he'd already read through the entire document. And he would sit down and he would say, okay, I know what you knew yesterday. What do you know since this got through compliance, since this got through clearance, security clearance? What's happened since you wrote this? Because I don't need to know about any of this. Because they're all prepared to like rehash and regurgitate everything that they've written. And he's like, no, we're not going to do that. You're going to tell me what's happened since you wrote this.
Oh, wow, that's cool.
And they were, it was.
That's different?
Yeah.
I bet it shook them up.
It did. And it was really cool to be in that kind of an environment when it was just a different way of looking at them. I think that's the difference between economics and finance. What do you think?
Oh.
Because people are always, I think too many people marry them together and they're distinct.
I do think that they are different to some extent.
Well, they're related.
They are related, yeah. Finance, it works so fast. So here's how I think of it is, we often get questions from clients around, well, here's what we're seeing in the economy or what we're reading, or should we be freaked out about, what we think the Fed is going to do, or what's happening in the geopolitical arena. All of these types of questions that have to do with the real economy. And the underlying question, at least I assume the underlying question, since they're asking me where I'm more in the investing world, is what should I do in my portfolio? And I always try to point out they are different questions. Just because you might have fears about what will happen in the real economy, whether it's we're about to go into a recession or inflation or whatever it is, it might not impact what you do in your portfolio because everybody is also looking at the same economic data, are trying to guess what is going to happen in the real economy, and it's that forward expectation that gets built into asset prices. So in order for it to mean something for you to make a change in your portfolio, you have to know something that hasn't yet been priced in. It's kind of like you have to be smarter than the wisdom of the crowds.
Right.
And that's a much harder hurdle. So it's not clear that
it's like citing black swans. Who can do that?
Well, it's a hard task. So that's how I think they are different. And it's a nuanced I think it's a nuanced point, and it's not to say the economy doesn't matter for your portfolio. That's the opposite. It's just that it matters a lot, so much, where so many people are paying attention to it. Mm-hmm. And because of that, all of any kind of change in the information set, new information, it's really hard to get that right more times than the market will.
Mm-hmm. So the efficient frontier.
Yeah.
What is it?
Oh, okay. Well, it's a theoretical construct that you learn about in an MBA course.
I know. I learned, but I'm putting you on the spot.
Okay, so it's the efficient frontier is an idea that you can hold a portfolio that's the best combination to give you the highest returns or expected returns for a level of risk. So that's the Vegas.
Fama would be proud right now.
Well,
that was good.
You notice that I didn't even say for a level of standard deviation, because
Right.
risk actually can take lots of forms. So that's why it's a bit of a nebulous concept.
Yep. So I set you up on purpose.
Okay.
So we were talking before that Warren Buffett had read me when I was in my young days, when I was in between Wall Street and the Fed, and invited me out to Omaha. But I actually got to know Charlie Munger when I was out there, which was such a delight. Charlie Munger is like Warren Buffett without a governor in his mouth. Whatever he is thinking, he says out loud, just boom. I mean, I guess the difference, he's 96 something, whatever he is. But we got to talking about public pension asset allocation.
Oh, okay.
And he basically said, if the public pension advisory, and this was 2004, so years ago, but he said, if the public pension advisory construct does not change, then maybe not in my lifetime, but in your lifetime, the efficient frontier is going to go the way of the dodo bird. And you see, you were at the Booth School of Business. You were in Illinois, which has got like a mushroom cloud over it. Its pensions are so underfunded.
Yeah.
And yet, the more underfunded they get, the more they pile into alternatives.
Yeah.
So, two big questions. How has the efficient frontier had to change in a post-quantitative easing, post-Fed unconventional monetary policy world? And separately after that, let's talk about alternative investments coming into the retail space and how you feel about that. So two separate questions.
Okay. So I'm going to answer a slightly different question. So instead of the efficient frontier, just are markets efficient?
Yes.
And to that, and I believe that Fama would answer that an absolute no, which sometimes people I think would be surprised by.
Well, they think that he is the efficient frontier person. You can't deny your work, but
exactly.
the word dynamic.
Exactly.
If the facts change?
Well, the way he described it, and I do think that this is a good framework for thinking about it, is the efficient frontier, the efficient markets hypothesis. It's just a model. It's not, no models are true. Just,
so refreshing to hear this. Yay! I still have PTSD from too many years of being a central banker. It's just a model.
They're approximations, and just how good of an approximation is dependent on, well, can you extract good insights from it, even if you know it's not true, right? We do this all the time. We make approximations to guide us, because if we paid attention to every single detail, then that's reality, and then you'd be bogged down in just too much stuff. So we always use these constructs to help guide decision making, or just get.
It's just like your young boys need structure.
Exactly.
If they don't have structure, they'll go off the rails.
Exactly.
And you don't want to see a 6 and 8 year old boy go off the rails.
Oh my gosh! Well, that's every evening.
Well, yes. When they were very young, we called it the unhappy hour, between 6 and 8 p.m.
Yes. Oh my gosh, just getting them to brush their teeth. So, where was I? Models and the efficient markets.
Yeah, you have to have a structure. You have to have a framework.
You have to have a framework. And this one's pretty darn good, where if you behave as if markets were efficient, so you're not trying to read the tea leaves and figure out things in advance of the rest of everybody else in the market, then you can do okay.
Yeah.
And that's what we've seen, right? There's been a huge flow to index funds, which basically don't try to time markets, don't try to pick individual stocks, and they oftentimes do better than your average stock picker, market timer,
Of course.
et cetera.
I mean, we've seen the degradation in your career. You've seen active management really get hammered.
Yeah. It's a hard hurdle to beat, just picking a passive index fund. That's certainly not what we do. We think that there is ways that you can, add value, but it's really hard to do, trying to figure out how markets are like mispricing things.
Yeah.
So, we know it's not true. There probably are people who are fantastic at picking them or figuring out where the markets are going better than the rest of the market participants out there. But it's just a very hard task. So for your everyday investor, they should know that they don't have to do that to have a good investment experience.
Right.
And that's how I think of the takeaway from the efficient markets hypothesis or the efficient frontier is, if you're pretty well diversified and you're disciplined, then you're probably going to do okay. And if you think that you can do better and get in and out of the market or pick concentrated portfolios, there are some people who probably can do that, but they're not the majority for sure.
No, they're dancing on ice, thin ice.
Yeah.
Yeah, I mean, it's funny because people are always like, why do you always talk about municipal bonds, Danielle? And I'm like, well, because I was on Wall Street when the dot-com bubble imploded, and at the time, I took the direction of some true market veterans, one of whom had gone to Columbia Business School with Warren Buffett and learned from, the other gods of finance.
Yeah.
And I will never forget taking their tutelage and making sure that as the NASDAQ bubble got bigger and bigger and bigger, that the municipal bond allocation got bigger and bigger and bigger.
Yeah.
And so I've heard, and so a lot of people got saved by that.
Yeah.
And so since then, since my 20s, I've owned municipal bonds, and people are like, that's not how you design a portfolio. And I'm like, there's no set rule.
Yeah.
And yet now they have, I remember, because DLJ was, had a merchant bank. It had Leon Black walking through the halls. It had Tony, it had the gods of private equity before private equity was a thing.
And now it's a huge thing.
In the 90s. And now it's a huge thing, and now it's bleeding into the retail space.
Yeah.
I mean, you used to have, be a certified investor and have a certain net worth, and you have to vouch for your, certain amount of liquidity in your brokerage account and blah, 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 in order to even qualify to invest in one of these things.
That's right.
And then they invented fund of funds, which had a lot of fees. And then it's bled into the retail space. Are these appropriate investments for retail investors?
It's a hard one to answer, only because there's so, within the alternative space, there's so much in it. And generally, you can't buy an index fund of private equity or venture capital. Right? So there is much more of a selection component, and the transparency to figure out what is a good investment, how much in fees are you actually paying, that I don't want to say it's not appropriate for every investor, but that is a higher hurdle than just saying I'm going to invest in an index fund with thousands of companies. So I do think that one is one that's going to require a lot more from investors to evaluate. And here's one thing that, as they come further down market, I think that there's who are the investors that they are competing with. All of the public pensions have huge allocations, and they generally have fairly substantial asset pools to invest.
Yep.
So
I remember, I don't mean to interrupt, but I remember that the CalPERS could not identify what they were paying in fees to private equity.
Yes.
When they were asked publicly. I'm like, that's not good.
Yes. So there are substantial hurdles, let's just put it that way. And also the CalPERS, you'd figure that they'd be the ones to get their first pick of managers.
Yeah.
So there's a limited set of deals out there. So that...
It's scary when you hear people like the head of Blackstone today said that there were no good deals out there, and you're like, okay, I think that means the market's overvalued.
Well, how is,
I think that was the message.
Yeah, if you're an individual investor,
yeah,
you just have to recognize that there are a lot of professionals in this space, and you are now competing with them to find the best manager for you. The managers are competing to find the best deals, and there's a limited set of them. So there are some substantial hurdles that do not exist in the public equity space for regular investors.
Very well said. Very well said. Agreed. So we're at a similar juncture as where we were in late 2017. 2017, of course, the VIX closed south of 10. I want to say 54 times. Like the prior time that it had closed south of 10 in multiple times in 1 year was like 1996.
Yeah.
When Greenspan said irrational exuberance.
Yeah.
So way back when. But 2017 was, of course, very complacent. It was a time of complacency in markets.
Yeah.
And there, with good reason. There was $2.1 trillion of global QE being pumped into the markets. I mean, there was a lot of money.
Yeah.
And I'll never forget Michael Hartnett at Bank of America, who publishes the Flow Show every Thursday night, which I follow. And he was like, you can't unplug these markets from liquidity.
Yeah.
You can't do quantitative tightening. And
Yeah.
of course, we had Volmageddon on, basically Jay Powell's first day in office. My question is, back in 2017, retail investors really weren't there. They weren't part of the market compared to where we are today. When we're talking about Fed liquidity coming off of its highs, when we're talking about the prospect of tightening, no matter how you want to define it. But today, retail investors are way present. So how do you figure that into your framework?
Whew. They're making themselves, retail investors are making themselves, their presence known through these meme stocks and,
chat rooms and, all this new vocabulary this old stogie had to learn in the last 18 months.
Oh,
Anyways,
I know.
What's a Reddit? Mom.
YOLO.
I'm Googling TikTok. Okay, got it.
But in the end, there's still, I do think that there's a new set of investors that are, trying to flex their power. But they're only one part of the market, and then there's people that need to save for retirement. There's public pensions. There's still a huge market of investors that are your more traditional investors. So, as we think about how all of these things impact potential markets, in the end, the market has to be held. And in the end, I think that people will only invest if they actually expect some positive return. Maybe for a small subset, they just want to get some bragging rights and some jollies and ride the volatility. Get in, get out.
Oh yeah.
Certainly.
That there's big, hot institutional investors that are following these meme trades in and out. That there's big money behind them.
Yeah.
And they're just playing it.
Yeah. Yes. But I don't know. I think that you can only believe that there's positive expected returns every day. Although when you look at where markets are being priced, so for example, if you look at aggregate price to book ratios, price to earnings ratios, they are over the entire US market, depending on what metric you're looking at, we are looking kind of high.
That was really diplomatic too.
At levels that we haven't seen since the late 90s. On the other hand, if you carve apart the market a bit more, a lot of that happens to be in your more expensive names. So your growth stocks, whether it's large growth, small growth, your FANGs, your technology stocks, they do tend to be more expensive. And then if you look at your value stocks, those look very stable. So they've had a good year, but where you look at the prices, they still look like they've got plenty of room to go.
Yeah.
So I do think that it's when we talk about the market has a lot of different components to it. So, if you look at the whole aggregate thing, it's looking a lot like it did back in the 90s. But as you start to peel back things, I think that there are segments where things look less pricey.
Okay.
So that's where we would tend to focus.
So I had a tweet shared with me a few days ago, and this tweet was just this little message that said, I invested $5,000 in Dogecoin. Now it's $2,400. How do I get the other $2,600 back? And I'm like, hashtag sarcasm? Is that a joke? And it wasn't. It was just a young kid who was like, where's my $2,600?
Oh, wow.
I want it back.
Oh.
And I'm like, but he or she, I don't know, will probably be a better investor one day for that experience.
Yeah.
But what do you make of this cryptocurrency? Is cryptocurrency an asset class or is it currency?
Well, I think it's a bit of neither.
Yay! Okay, Danielle, tell us how you really feel. All right, keep going. Whoa, I'm going to get some hate mail on this one. Okay, all right.
Well, okay. When I think of a stock or a bond or a private equity investment, the money is going to fuel economic activity, right? We're basically making a loan to a company so that they can invest it and build a business, and that business hopefully creates additional revenues, not all the time, so there's risk.
Yep.
But there's an economic reason why you expect growth in your cash flows in the future.
There's an asset.
There's an
somewhere
asset.
There's an asset somewhere. Yeah.
Crypto might be closer to a currency in that, currency has no cash flows associated with it. Its value is held up by the faith that you can buy stuff with it. But there's so many, at least today, there's so many frictions in using, Bitcoin or any other cryptocurrency to actually purchase things in your regular life.
To transact, yeah.
And you throw on top of that just the, emissions considerations. So it's definitely not a particularly green store of value.
Right.
And I know that some are working on that, but at least today, there's a huge amount of energy and emissions going in to create these things. Plus all of the frictions involved. I don't know. It seems like a very, I'm going to buy it type of security, I don't know what you want to call it, with the hopes of someone else will buy it for me in the future for more. But they may not. And there's no real economic reason why it should sell for more tomorrow. So, it all seems very, and I understand that those who are true believers in it, they see a future in which the technology is very interesting, the digital ledger and
sure,
those types of things. But
I don't think anybody
itself,
denies that.
Yeah, the currency itself.
I mean, when you wake up on a Saturday morning and you're like, the entire crypto universe is down 20% today, and you're like, wait a minute, the market's not open. This thing trades 24/7. It's down 20% on a Saturday. It's like, wait a minute, what happened?
Well, I will admit that
And the financial media loves it.
Yes. Well, because it's so volatile. It makes for
Good
a
headlines.
Story just about every day, even on holidays.
It's like Trump, but a currency with his volatility.
So here's what we would say to an investor is, look, if you want to invest in something that is that volatile, that really doesn't have a good economic reason for why it should have a positive expected return, that's great. Just be ready to lose it all.
Yeah.
So if you go in with that mindset, it's kind of like how I go to Vegas. It's just I'm probably going to lose it all, but it's fun.
I call gambling spending money.
Exactly. It's for consumption. Yeah.
And if I make any, then it's called a new pair of shoes. And if I don't, then I will have spent the money. How it goes.
Yes, exactly. Same for crypto.
So we have seen an explosion of ESG.
Yeah.
It's like woke, but for investors. Yes, I just said that out loud. Again, you're going to get more hate mail.
It was so good. Can I borrow that?
Yes. Has the trend, I mean, it feels like it's just exploded.
Yeah, and I think it depends on also where you are, because
I mean, if you're in funeral services, for example, should you be worried about ESG?
Well, I say this because if
investors ask the question.
If you think it's exploded here, I mean, just in other regions of the world, it's I don't know what's past explosion. It's gone nuclear. So, there's if you look to, for example, Europe and think that maybe we're just a few years behind, there's a lot more to come in that case. Now, I do think that there has been an explosion. Well, let's just first define ESG.
Sure.
It's environmental, social, and governance. So I always want to do that because it's not all the same thing.
No.
Governance has been studied for forever,
right.
And that's something that I think any responsible investor or investment manager should be focused on,
sure.
of creating value through governance. But
I mean, we look back at the Enrons and the WorldComs of the world, and their boards of directors were out to lunch, and there was no governance.
Exactly. Are the board of directors doing their job to look after shareholder interests? That's always important. The environmental, social, and those also have very different definitions. It's a whole hodgepodge where that, I think, is some of the what's to come is more data, more consistency, or at least better frameworks or meanings tied to some of these words. Because right now you can say that you're focused on ESG, but that doesn't actually convey much meaning to the end investor, because there's so many different, there's 80, 100,
sure.
I don't know, different variables that fit into these categories. So what exactly does that mean? First, I think investors should really ask themselves, what is it that they hope to accomplish with their ESG investing? And this is the other trend that I think is coming, which is the explosion. Seems like a lot of greenwashing is, the term now of, you can market it as ESG, but what are you actually doing? What are the real world implications? And I can tell you, if you sell a stock to another investor, there has been no reduction in emissions in that trade. The company is not affected by one person buying and one person selling.
I'm going to use that.
So that's where I think there's a rub, where yes, there's huge work that needs to be done to address climate change. But can you do it in your portfolio? Not at the Fed.
Not in your portfolio.
The impacts that you can make by trying to kick out certain stocks out of your portfolio, that's not where the action is going to come.
Yeah.
You need innovation. I can't believe this is coming out of my mouth. You need regulation.
There's a thought.
Changing consumer behavior. Those are real actions. And if you want to have ESG in your portfolio because that better reflects your values, that's great. But you can't just say, I've done my job because I've invested in an ESG portfolio. That's not enough. So
agreed. And it's so easy to say and then just walk away.
Yeah.
And some of the biggest firms are involved in it, but it's still kind of smoke and mirrors.
It's smoke and mirrors, and even at the corporate level, right? Like it's if you can. There's a lot of what feels like empty promises or commitments that, we'll do something by 2050. I mean, that CEO is not going to be in his job at 2050. So what does that mean? That's
like being in Buenos Aires and going, I've got a nice government bond to sell you. It matures in 2050. I'll be like, hold my beer. I'll be right back. So I'm going to ask a trick question.
Oh, I love those.
Is passive investing passive?
Ooh, no. So there are several, especially not these days. Okay, so what is considered passive investing, at least in the industry nomenclature these days, would be an index fund. So there's you set up a fund where the entire goal is to track some sort of index. But the index has a lot of rules and decisions that go into it, and they may be very active type of decisions, right? Like, I want to hold these set of stocks. I want to rebalance in this way. And so that, there are decisions that are embedded in that. I like to think of it more as, okay, so first, why the truest passive investing in my mind is just you buy the market and you hold it and you don't do anything. And you can do that. So I think of that as almost like your original passive indexing.
Sure.
And since you have,
that's why Vanguard became Vanguard.
Yeah.
Back in the day.
Yeah. So you have all of these different indices that reflect little segments of the market, little niches. You can do a lot of active bets on using ETFs, which are a passive vehicle. So I do think that this idea of passive active is we still use it, but it doesn't really have the same meaning as it did 30 years ago. So the nomenclature that I think of is, okay, passive is just holding the market. And if you deviate from the market, if you want to overweight certain segments, exclude others, all of those types of things, in the end, they're an active decision, regardless of if you have an active using industry nomenclature, whether you're doing that using ETFs and index funds or you're doing it using an active manager. So
is it me, or are there a lot more ETFs than there used to be?
There are a lot of ETFs. I mean, you can get any type of ETF these days, like every single little flavor.
But if you drill down, then you're like picking.
Yes,
It's
not passive.
the definition of active.
It's not passive. And if you look at the most traded securities on the exchanges, there are things like ETFs. So
structures that have not been tested. I like to remind people. People don't want to be reminded of that, by the way. Just go back to the Fed. No, not happening.
So yeah, the nomenclature hasn't caught up with the times.
So how are investors reacting to, in many situations, the first inflation they've seen in their investing lifetimes?
Well, we're getting a lot of questions, and I keep thinking that it's past us in the art, but they are not, as we clearly see. So there's certainly a lot of questions. And inflation is one of those things that, what's being priced in, if you, for example, look at break-even inflation, it doesn't look all that high, troubling, especially if you go all the way out. But in the end, nobody knows. That's what's being priced in. It could be higher, could be lower. And if the level of inflation is something that is going to impact you, and it impacts all of us as spenders, and if you think about a typical retiree,
you took the words right out of my mouth. Somebody on a fixed income.
Yeah, if they've got, people think, if you think that retiring or spending or saving for retirement is about getting to 65 and then you're done, oh my gosh, you still have decades ahead of you that you need your retirement savings to last.
And that assumption used to be predicated on having paid off your mortgage when you turn 65 and you retire. So you don't have a big, gigantic, line item in your budget.
Yeah.
But you see 75, 80-year-old people with mortgages.
Yeah, and healthcare expenses. There's lots of different things that you have to just consider over a multiple decade spending period where where your earning years are behind you, and inflation is one of them. So we think it's really important for people to always consider thinking about hedging against inflation risk in their portfolios, regardless of whether they're worried about what the Fed is doing coming off QE. All of those things, they could always happen. So inflation is always there, and we think that that's an important risk for retirees to think about and account for when they're constructing their portfolios.
So let's wrap this up with two opposite ends of the spectrum here. We've seen a wave of retirees, multiple million more in 2020 and 2021 because of the pandemic. If somebody says to you in passing, and they don't know who you are in your day job, Marlena, I'm going to start taking my Social Security the minute I can. What do you tell them?
Well, I would tell them to talk to an advisor, but
Again, very diplomatic. Please seek the guidance of a financial advisor professional.
I mean, we know that generally, the rule of thumb, wait and put it off if you can.
Yep. And yet we saw this massive wave come and collect it as just life is too short. And I'm like,
life is too short. Yeah.
We might be talking about them coming back into the workforce one day.
This is one of those things of, I do think that people, I'll speak for myself, thinking about decade-long investment horizon, planning horizon, it's really hard to think about, especially when you have immediate demands just occupying all of your mind space. So that's why I think I do say, fine, go talk to an advisor. I have an advisor. I know everything there is about investing. Well, maybe not everything, but I do tell my advisor, I don't need your investment help, but I do need help with the rest of it, which is big.
Yeah.
And it's something that gives you just a moment in space to think about your future self. Your future self might be in 5 years, in 10 years, in 30 years. Mm-hmm. But having a plan where you're not letting your next month self kind of screw over your 30-year in the future self is really important, and that's a financial plan.
Discipline.
Discipline is what it is.
Discipline. Yeah. So let's go to the opposite end of the spectrum.
Okay.
How do you convey the importance of saving to your boys?
Oh, well, I've experimented with this that you're talking about, which is we'll match.
Match. We do the 401k match. We do.
Oh, okay.
Basically, what you save will double if you put it in your savings account.
Yeah. But besides that, we've not been very good about giving them an allowance and making them spend out of it. But my older son, he's kind of obsessed with money, so he said, Mom, can I have a credit card? And at first I was taken aback thinking, no, you cannot have a credit card. But then he's like, no, just a paper one. So it was very cute. Oh. He drew a little paper, and it's a debit thing where he gave me $100 and he wrote 100 on it, and then every time he wants to buy something, he erases it and subtracts. It's very sweet. Oh. And that's exactly how I grew up. My mom, she was an accountant. So I had a debit credit.
You had a ledger.
Exactly.
Love it.
So he's very financially aware.
Here's the University of Texas, where I almost got my MPA instead of my MBA. I do not regret not becoming a bean counter. No offense to all accountants out there. Sorry.
Absolutely. So I don't know. I think that he seems naturally just drawn to it, but he will ask me things like, there's a tension between, he's impatient, and he says, Mom, can I get a part-time job? And I'm like, you're 8. No, you cannot.
They're lost against this.
So I always stress the importance of no, because you should focus more on what it will take for you to earn a lot in the future.
Yep.
And that's not getting a job today. It's thinking about your education, thinking about, so
you're investing in your future.
It's so
and
sweet.
Education is an investment in your future.
Yeah, kids are always such in a rush to grow up.
Yeah, I always tell mine that when if they don't want to do their homework, I'm like, that's okay, you can be poor one day. Mom, I'm like, no, it's a choice you can make. Whether you either do your homework or you don't. And they're like, don't put it that way. And I'm like, okay.
Yeah, I do tell him, you don't need to worry about money right now.
Yeah.
But you need to worry about it after you're done with school. So
at what age do you think people should start investing? Or saving, Saving. I
mean, it's a habit. So
the minute you get your first job.
The minute, yes, yeah. I did not, but my mom did it for me. And as soon as I got my first job, she started making contributions to an IRA for me.
This generation doesn't know what an IRA is.
Okay.
I have one. Showing my age.
Let's see. I think I was in college when she handed it over to me. So I had a meaningful amount that I also couldn't extract without penalties. But then that gave me enough where investing did feel real. When she gave it to me, it was a couple $1,000s, but it was still a substantial amount to me. I was a high school student, college student. And so that's something that I absolutely intend to do. The earlier you start, it feels like it's just a muscle, just like everything else. You just have to start exercising it early, regularly, and
Don't let it atrophy.
Yeah, exactly.
It's been great. You're a font of knowledge, and I thank you so much for your time and all the guidance that you've provided, hopefully to especially the youngest viewers of Down the Middle. So thank you for your time. Let's do this again sometime.
It has been so fun. Thanks for having me.
Absolutely. Well, I hope you enjoyed visiting with Marlena as much as I did. She is the definition of active investing in a world where passive sometimes feels like it's completely taking over the game. If you want another viewpoint of the importance and the relevance of active investing, I would invite you to go back into the archives and watch the interview that I did with my dearly departed friend Tobias Lefkovich. And he had such wisdom and insights about the importance of active investing and maintaining activism in your portfolio. So if you enjoyed Marlena's views, go back and watch Tobias, and I will look forward to seeing you the next time for the next episode of Down the Middle. Thank you.